Okay, we're live. Hi, Charlie. Welcome to Venture with Grace.
Hi, Grace. Great to get the chance to speak.
To start the show, I would love for the audience to get to know you a little bit more. So actually, you started your career as a surgeon. I was quite surprised. I thought, I know that you're a founder, but can you share a little bit more about, what was the journey like from being a surgeon to now the Chief Investment Strategist at ARK Invest?
Yeah, absolutely. Look, I think as going through medicine, and then eventually into surgery, one's invested so much time and effort and thought, and frankly, just a lot of rote learning, and just having to learn about a huge amount of things, some of which you're interested in, some of which are a real challenge to get your head around. And I think for me, quite early in the surgical career, and I did about 5 or 6 years actually in the end, through general surgery and then into reconstructive plastic surgery, not the aesthetic kind, but the repairing cancer and injuries sort of kind. But yeah, I realized quite early on that I actually was more interested in creating products and new things that could help people at much more scale, and that where my some level of design and invention would come in, and I could try and fix problems by breaking the problem down and thinking about different innovations that might work end to end, maybe recombining technologies. And so I was constantly kind of at the clinic or whatever and daydreaming ideas that would maybe make for new medical devices and things like that. So eventually I just thought, if I carry on in this path of wanting to be both an inventor, entrepreneur, and a surgeon or a doctor, I'm going to just do a bad job of both. So at some point it felt like it was the right time to just jump and go full time into one, and entrepreneurship one. There's actually a great analogy on this, I think, that a friend of mine who was a doctor, an ER surgeon actually, and then became an extremely successful biotech entrepreneur, banker first, and then a biotech entrepreneur and board member, has about this, which is that he likens it to, he sold 2 very, very late stage biotech companies, both for over 10 billion to a large pharma. And both, more importantly than the numbers, were shipping drugs helping patients and things like prostate cancer. I think the number 2 prostate cancer drug in the world was one of his that he was involved with. But anyway, his analogy was, as a doctor, you get to help hundreds or hopefully thousands or even tens of thousands of people, and you really have that amazing opportunity to have the live feedback, and you get that impact on you enjoy the job because you can see people hopefully getting better and be really a part of their improvement in their health and their journey. And it's that immediacy is akin, as he put it, to a stage actor, where you're sort of standing on stage and you can see the people in the audience and you can see the reactions and you have that immediate feedback. Whereas if you become then a medical entrepreneur, whether you're working in pharma or medical devices or whatever, it's more akin to being maybe a screen actor, and you might be affecting potentially millions of people. Well, there's a lot more risk in whether any of the thing you work on actually work in the end. But you don't have that immediacy, and you have to sort of take it as read and just understand and know that if you build products that then get FDA approved or whatever, and then get to patients, that they will be helping people. I've actually been thinking recently about ways to bring that loop back and learning more about the actual deployment of some of the products I've been involved with. And to continue that line of thinking, the first company I was involved in co-founding was a UK public company recently acquired off the markets, working on non-invasive prenatal testing, which is a blood test, which is somewhat of a replacement for amniocentesis, because you don't really want to ideally do amniocentesis because there's a small risk of actually leading to a miscarriage. And that company that I co-founded, the first thing I did actually coming out of surgery right back in 2007, ultimately did 2 million tests, which, given the miscarriage rate of amniocentesis and the obviation of many, many amniocenteses, means that there are certainly hundreds, probably thousands of people walking around, mainly in the UK and Europe, but actually all over the world, who didn't become a miscarriage because of an amniocentesis that didn't happen. Now, I don't know who those people are. They don't know who they are because it's just statistical, right? But it's amazing to know that there are those people walking around that wouldn't otherwise possibly exist because an amniocentesis would have happened instead of the technology we brought forward. So things like that, when you sort of run the numbers and you think about those lives that you may have impacted, are very, very gratifying. Even though one misses not having, not being there in the trenches and working and doing operations and seeing the outcomes. So anyway, long-winded answer to your question, but maybe it made some sense.
I wonder, so like, yeah, totally. I think like one of the things I wanted to learn more about is like, you are a co-founder of Freenome, and it is a company that not recently, but this year they raised like over $200 million again. And then now you are the Chief Investment Strategist at ARK Investment. And like, I wonder, what were some lessons that you've took from the entrepreneurial era to being an investor now?
Yeah, absolutely. Look, I think I do really believe in the idea of operators going to the investment side and vice versa. I think you learn so much by being both sides of the table, maybe going back and forward. Hopefully not sort of too like a ping pong game, but at least a couple of times in your career it makes sense to do that. I mean, one obvious one is fundraising, right? Like in both directions, you learn a lot about the fundraising process, what investors need to hear and what companies need to communicate to investors to make sure that the message and the narrative gets across. I think, so there's a lot of that like advocacy that translates into an investment pitch, and really trying to refine that, be focused, not give excess information, not oversell, not undersell. And then, hopefully a lot of those learnings come through to thinking when you're on the other side of the table as an investor, and sort of trying to read between the lines. What is this company telling me? What are they not telling me? How do I try and get some of the subtext? What skeletons are in the closet or maybe of this company, whether they're just things that they're not reporting on, stuff they've tried and failed, but, doesn't make it to the investment pitch. And where can we double click and just press a little bit more and learn a little bit more about that? Also learning, a lot about building companies, about talent, about making sure to keep momentum around the different parts of a company, because every company is an interacting organism essentially with all these feedback loops and all these things that go on among and between the different parts of the company and are really necessary to drive balanced growth, as it were, and being, not falling over one part of the company because it's slowed down or what have you. I think so. Yeah, organizations, team build. Also, just the need for incredible operational people and really, like, who is it that's coming up with the ideas and the strategy and communicating those? Who is it that's actually keeping the trains running on time and why? And really having seen all of those different phenotypes, trying to, on the investment side of the table, double click on those and really think about, obviously in a late stage company, it's easier to determine because you've got a lot more proof points of whether execution is actually happening and whether it's along a strategically meaningful direction. Because one of the biggest failings, as we know, is companies running very fast and very effectively, but in the wrong direction. And when, as an investor, I think a lot of the thinking that I always look for, especially in an early stage company, as again, having been born of, founding companies like Freenome, where I was one of the two original co-founders with Riley, who's still at the company as chief product officer, and I speak to very frequently. But it's really thinking, it doesn't really matter which domain you're in, but every company I always think needs sort of three pillars to stand on, even if it's got two co-founders. Sometimes those three pillars are done by two people or even one person exceptionally. I think of those three pillars as being someone that's really got an innovation and a disruptive vision and a vision of a new future, and maybe some sense of how to get there. Someone who knows how to keep the trains running on time, really deep operations, just loves task management right down to the minutes and the stand-ups, and they're just making stuff happen, who gets up every single day and just loves operations. And then someone, or, as I say, these could be in, exceptionally all in one person or often in two, or it could be three or more co-founders. And then someone who's much more externally facing often is the person that wants to be posting and doing BD deals often and inspiring people around partnerships and maybe if necessary in that industry, going to the cocktail parties and meeting the people who might then do the partnerships. So often that person is quite involved in the fundraising as well. And I think if you don't have those three pillars, and they often really are very different phenotypes, and often it very much depends on the setting, whether it's biotech or technology, enterprise, all these things are different. Often that inspiring leader who comes up with a disruptive idea is also a technical co-founder and can actually code and execute on things. You may also have the operations person that's highly technical and to deliver code and big coding projects. But also you often see that kind of external facing BD social role also coexisting in the same person as the sort of inspiring person who's got the disruptive vision. So it can really vary by company, by founding team, and by industry. But I always feel if you don't have those three pillars quite well covered off at some level, then there's a bit of a gap in the team. The company sort of can go either too introspective or too almost too extroverted and not get enough done, or can just be just not executing in the way that you need that level of deep ops to deliver on a startup.
Totally. Yeah. I wonder, so like, since you come from the biotech background, and then I feel like nowadays, like, so we met at an AI event. I wonder, I know that like ARK is very bullish on AI. So yesterday I was listening to an interview with Kathy that she basically speak very highly about NVIDIA back in 2018. I know that you guys have hired someone from NVIDIA maybe since like 2016 or even earlier. I wonder, so like, what are the theses that you would apply into a venture investment versus a like basically like, for like the public market investment, like what's a comparison between your strategies in both of these markets? And then from the AI perspective, I wonder, what are your takes on the AI spectrum? So since you guys made a lot of bets in the category, like Anthropic and other companies, what's your overall thesis about AI?
That's a very big question, or lots of questions in one. Maybe I take them separately. I think in terms of, maybe I could speak in the general about venture versus public, and then I'll talk about AI. Maybe I think if I can divide them, if that's all right with you, into two separate questions. I mean, I think, obviously some of what's different about investing in private and public is trying to figure out with the public side what is truly not priced in, and where might market inefficiencies lie. And our worldview for ARK is that generally, obviously markets are frequently efficient. There's obviously raging debate about how efficient they are and over what timescales. But what we believe is that there are commonly inefficiencies that come in over the timescales in which we care about, which is typically 5 years and up, actually even more on the venture side often. But even, most of our public market bets are in, have that kind of mindset of that and beyond in terms of timescale. And we think that there are often market inefficiencies that come in because people, maybe over-index on the most recent quarter, the earnings, just the news flow day to day, and under-index on things like where really does this product sit and this product trajectory, or what new products are coming through, how incredible is this team and the technology and the traction they're getting that has a multi-year payoff. So we spend a lot of time studying talent, really thinking deeply about products and how the future landscape is going to evolve, as do all investors. But I think that's where we feel that those dislocations often lie, and you can kind of see that, right? When, it's fairly obvious sometimes when you see the overcorrections and undercorrections that markets are not efficient over certainly some level of time scale. So that, whereas with venture, a lot of your market inefficiencies or your edge is coming from a different place. Like it's often coming from things like access, or having spotted something very early on and working with and even sometimes coaching founders and actually then hopefully adding value. And really the best VCs are way more than their money. I think, back to your question before about, other things I learned as a founder and an exec in different startups was, every investor claims to be more than their money. Sadly, that's often not the case, just because investors are busy sometimes, not that they don't mean to be helpful, but that sometimes, just don't have time and bandwidth. Sometimes they don't have access to the things you want access to. Obviously some investors are actively unhelpful in various ways, either distracting or all sorts of things. And so I think on the venture side, it's just very different, because you can really help a company, especially a small early company that maybe doesn't have like a fully developed CRM and a bulk black book of people groups that can help them. We try to also help the public companies, actually. So there are a few recent examples, I won't name them, but where I made some introductions to some very senior people in the immuno-oncology space, who I think may then form part of the scientific advisory board for one of our public companies. And, I just got a text actually from the CEO the other day just saying, thank you so much. Like, that was a super, super helpful. And it's actually kind of gratifying that even in, a reasonably sized Nasdaq company, you can still be helpful in that kind of a way. But obviously the leverage and the impact in helping a 5-person startup is way, way bigger. So yeah, I would say the differences are you're still trying to find market inefficiency. Often it's not called that in venture, but it's the same kind of thing. But it's more driven by, can you access the company in the first place? Because often the great deals get quite contested. Also, can you spot deals that the market for some reason has kind of overlooked, right? Like this is an analogy, but the Harry Potter kind of thing, right? Where J.K. Rowling shopped Harry Potter to pretty much every publisher under the sun, and then the last one I think was Bloomsbury, who finally took it, and she was about to give up, and that became the multi-billion-dollar franchise. And the same thing happens in venture, but quite rarely. I think if you see some of the top 1%, top tier venture funds investing, that's a pretty safe bet that that's probably going to be a great company or a decent company, and is certainly going to have a lot of help along the way, and probably will not run out of money because it will still be funded, because there's a lot of money chasing the companies that the top tier investors invested in the first place. But there are definitely examples of where there is a proper market inefficiency, a true market inefficiency in venture, where it's just not spotted early on, or only spotted by 1 or 2 funds. And we actually really look for those kinds of deals from ARK Venture. So we have a venture fund at ARK, which I can talk a bit more about. But what we love to find is where one of the top tier VCs that we really like is leading, because we don't lead, certainly at the moment. And so we feel that company is somewhat validated, like someone's done at least some minimum viable homework and really established that, kick the tires essentially with the founders and the background and a lot of the stuff that great VCs do, because we just don't have at the moment a big enough team or enough bandwidth to do that and to lead. But to take the slightly contrarian bets from those portfolios where at least one very top tier VC might be in there, and then maybe a few investors you haven't heard of, or family offices or angels or what have you. But at the other extreme, we sort of don't like the party rounds, right? Where you've got everyone just piling in and it's super oversubscribed and everyone's doing small checks. No one's really aligned that company with their reputation in terms of, having deep conviction and being excited to really, really double down and commit to that company. So I think, again, there will always be tail examples that don't fit into any of those things, but I think that's generally what we would look for on the venture side. So anyway, yeah, I can go to your AI question now if you like.
Totally. I have a quick piggyback question before the AI question is,
Sure.
I know that you guys have literally all the top cool logos on the venture side. Do you guys primarily invest in, call it like secondary, or like do you hunt them very early on? Since some of them are, OpenAI or Discord or Databricks, or Replit, so they're kind of around for a while, and then they're more towards like a later stage in the startup realm. And I wonder, so at what stage do you typically prefer the company to be at? And as you mentioned, maybe you guys are paying attention to them after they already have a lead investor, or more towards I guess a more mature side. So I wonder, just curious, at what stage do you go in? And then do you guys invest in the company that's completely unproven, as you mentioned about the market inefficiency? I guess they're not spot by the tier 1 investors yet, and maybe if you could give us some example there.
Yeah, sure. Again, you're testing my memory with these long questions. I'm going to do my best, but
sorry.
No, that's great. So I think, first of all, maybe I'll just give a quick overview of the ARK Venture Fund, because maybe that will inform on some of the questions. So it's quite a different kind of venture fund from anything that we believe has been out there before, and part of that is, and that will inform some of the question you asked, I think. So there's a few of the big differences are as follows. So one, it's available to essentially any even non-accredited investor. As you know, accreditation is usually $1 million in high net worth, in assets, in net worth, or over 200,000 or more in income. I think it's more with a spouse, 300,000 or whatever. But anyway, it's available to non-accredited investors who do not meet those criteria for accreditation, which would normally have been required for either investing directly in in private companies or as a venture fund LP. So that essentially that whole private market, high quality private market investing, whether directly in companies or through a venture fund, has been essentially excluded from all of these non-accredited investors for the longest time, which we just fundamentally found very undemocratic as a concept. And so the ARK Venture Fund is open to all of those people for anything above a $500 check, essentially. So, almost any investor who's sort of investing seriously would be in that category. And then we distribute it to those people and make it available on, right now, a couple of apps, but there will be many more coming in the coming time. So right now it's on Titan, which is an Andreessen-backed fintech app. A little bit like, I was going to say it's like Robinhood. It's actually quite different to Robinhood, but it's available to people. You can download it. It has, we're one of the main investment opportunities featured on there, and I think the only one in private venture in this way. And then we're also on SoFi, which people probably know of more. Maybe it's a bit bigger, but I think we're going to be rolling out some globally in the coming, certainly next year. I think there's several more coming online. Anyway, because it's available to non-accredited investors and we're getting constant flows in all the time, it's not like a normal venture fund where we might, might go and raise $500 million and then start deploying it and then raise fund 2 or fund 3. So it's a little different. So we have constant inflows. And then the other thing to note before I talk about the deal flow side is we also have liquidity available to the investors. So every quarter, up to 5% of the fund can be redeemed at the request of the investors. So they can essentially put in a redemption request and get their money out. And so even though it's up to 5%, it's never actually hit that ceiling. So anyone that's made any redemption request has had their full amount redeemed, actually. So actually, and I think it was if you look at the full calendar yearly, let's say of 2023, the fund was up about 60%, actually just over, I think. So someone who had invested, say, $1 million at the start of 2023 could literally have taken out that full 60% performance at the end of the year. So that that kind of thing is potentially quite interesting to people, is the pairing of the liquidity and the access. Now, on the deal flow side, then we enter companies. We typically are doing $1 to $5 million checks. I think the biggest we've done is 5. We have done much smaller than that into seed and pre-seed, actually. But typically think of us as like $1 to $5 million checks with an average of like 2 to 3, essentially. And because of that, and the fact that we have a lot of flexibility, we can enter companies by a primary round, a safe, or secondaries, or other safes or convertibles, but we typically do safes. Because of that, what we tend to do is start building a toehold in a company that we have great conviction, might only be $1 million, a couple million, but then we'll build into it through time often. So we may start with a secondary and move to hopefully the primary round the next time that happens, or vice versa. We've definitely got examples of both. But I think of the 30 or so private companies we have in the portfolio, around a third of those, we have already shown examples where we've concentrated into the company, whether it's through secondary, follow-on offering, or what have you. And with some of those, like Anthropic, that we did quite early on, we've been happy to pay a dramatic multiple on the original investment because we still have massive conviction in the company and we're very excited about it. And we maintain very active, ongoing relationships with all the secondary groups. In theory, we could sell out of a company if we lose conviction by a secondary too. We haven't actually had to do that yet, but yeah. So maybe, I don't know if that answered your venture question.
Yeah, totally. I wonder, so what's your picking criteria, since like there are a lot of companies that in a certain space that are pretty hot in a given moment, and then what are some cutoff lines that your team that will decide like to not pursue? I know that Kath kind of like taking a very different approach in the public market from picking the people on the team. So for example, people like yourself who is a domain expert in a particular category, and then maybe like researchers in a certain area that are very plugged into the community with all the resources or like knowledge to study or research a certain area. And then you guys are very vocal about it on social media platforms. I wonder, how does that kind of translate into picking from the venture side? Because it does sounds very similar from like the public market to venture side, but like public market, you have a lot more data because of like everything is kind of public information versus like private companies that are a lot of it were like unknown or you have to do a lot more diligence, and then there's more like volatility in that domain. And I wonder what would be your selection criteria to make these very concentrated bets in these companies?
Yeah, it's a good question. So, yeah, as you say, like one of the things that attracted me to ARK in the first place, well, Kathy and her passion, and I think incredible amount of economics knowledge and expertise, and having seen all of the cycles, and she's just an incredible teacher and mentor on that side as well. But as you say, a lot of the people driving the research in the research team, a lot of the analysts, research directors, and what have you, are incredible domain experts, and actually they've been practitioners. So they've actually, they've had companies, some of them have had their own, either hedge funds, or they've worked in crypto, or they've built stuff. And a lot of really deep product fundamentalists, I would say, who are really, really care about the products, and they're buying and owning and trying these things way ahead of, often the whole market, or, definitely our early adopters. So that's one whole side. I think on the venture side, in terms of as we pick companies, like clearly we care a ton about the products, even at the early stage. And, that's one area we dive very deep on and try and do as much as we can in terms of product demos or tryouts and things like that, as well as looking at the traction. I think we try to think about the company in itself, right? Like net of its talent, its, technology, team, and traction, I guess, of some of the big buckets we think about. And we actually have an adapted version of the ARK scoring system that we use on the public side. So we have a multi-point scoring system which looks at these things like product and traction, looks at the team, thesis risk, all this stuff. But on the venture side, so we're also obviously thinking about things a bit differently, because you've got valuation and the actual deal we would be going into. So it's almost like we think about the company in isolation, the deal, and we don't want to, if the company, because we're not leading, if the company's doing a follow-on round and it's got a new lead who's setting the price, then we can get, and that's one of the things we look for, is being very comfortable that like a fantastic addition, a VC who does lead is setting the price of that deal at that time. Because obviously, especially in the last couple of years, we've seen a lot of flat rounds and down rounds, and you really want to look and have a very, have a lot of confidence that there's a great lead has done the digging and reset that price. And then thirdly, we would look at the company in context of our portfolio, right? So net of the 30-ish private companies in the portfolio and around 25 public companies that we have in there as well, because it is truly a crossover fund with a strong, heavily venture leaning, but there's about an 80-20 split between private 80% and public 20 or sometimes 15%. So we think about the same 5 technology platforms. The ARK focuses on the public side, so that would be around artificial intelligence as this mother of all converging technologies, multiomic sequencing with precision medicine, energy storage, public blockchains, and autonomous and robotics. And so we're looking, just as we are on the public side, for the convergence among and between those technologies and the way that they're accelerating each other and driving forward really new, very impactful disruptions. And maybe, I know you asked about AI, I can talk a bit about that too, because I think, but clearly, as we've seen from Anthropic, XAI, and some of the other companies you mentioned that are in the portfolio, we think some of the most exciting AI R&D and product development has happened on the private side, right? So, very excited about companies like Anthropic, XAI, and others. And Mosaic, we have Databricks, as you said, as well. And that's actually because we had Mosaic ML before. That was the company we actually entered, and it got acquired into Databricks, which was great because we really wanted Databricks stock anyway. It was on our hit list. And actually, we got around the 700% annualized return from that acquisition into Databricks stock at the time. And, very, very bullish on Databricks generally as a story too. So we're excited to have that. And, that's a company we may eventually have more of. And of course, on the public side too, there is incredible AI stuff going on. Obviously, Meta just decided its earnings this week and doing some incredible stuff. We're very excited about open source. We're excited about the whole ecosystem that Llama, the Llama family of models, now Llama 3.1, are opening up, right? And this whole, maybe cottage industry is the wrong word, but this whole industry building up around them and great deployments of those models. And, much as with the internet the first time around and then mobile, I think the creativity of people paired with the massively powerful enabling technologies, in this case now, these huge foundation models made open source, there's really uncapped upside in the value generation and the ability of ways to help people that could come from that kind of thing. Of course, that's counterbalanced by, potentially misuse by bad actors of these very, very powerful models. That's well documented. There's this sort of raging debate about open source or closed source. I think our house view on that is really that given the cost declines that we're seeing, and depending on how you measure it, if you look at the ARK Big Ideas deck, for instance, from earlier in this year, we're seeing in the region of 75% cost decline per year of actual training costs for building large models. Now, of course, the actual cost to train a model in absolute terms is going up because the models are getting so big. But in terms of, if you extrapolate that outwards, this idea that no one should be making available these large public frontier models because say a terrorist group wouldn't be able to afford $100 million to train a model, but might be able to deploy it, which is an argument, and it really, really makes a ton of sense at some level. The reality is just that training cost is being crushed so much that even, obviously it's kind of moot because these models are being made publicly available now anyway via this open source movement. But even if they weren't, the cost is coming down at the moment anyway at such a rate that pretty soon anyone will be able to train these things. So at some level, right, like maybe, new emergent capabilities come through from these extremely large multi-trillion parameter models, and that's a whole other discussion. But certainly from what we can see at the moment, the cost declines are driving this paradigm that, these things, the genie is kind of out of the bottle on this thing anyway. So yeah, we're excited about the public side. There are companies that we think are extremely well positioned for the coming AI revolution. So we invested in XAI, Elon's company, for the pure AI side. But we're also very excited, as won't be a surprise to people probably, about Tesla as an AI opportunity. Obviously through autonomous as part of it, but also way beyond that. Of course, with the robot, the humanoid robot side, but also really the whole concept. And this comes through as well. We look for this on the venture side too, but the whole idea of embodied AI, where you have to build something like a piece of hardware that itself is out there in the world. And obviously the Model 3, let's say Tesla, is an extremely good example of that, where there are just so many of them driving around, gathering data. And it's just a massive moat if you've got this embodied AI and you've got this physical object that itself is very hard to build, generating data, which then becomes this huge data moat. So, we're very, very excited about that. Obviously, we're trying to be thoughtful on the venture side because, again, those things can be very capital intensive to build.
Totally. I wonder, so since you were just talking about Tesla, so I opened up like your quarterly report, like one of the most like exposure was like autonomous mobility sector. So I wonder, like, when it comes to how does that translate into early stage investment? I know that since like a lot of the listeners are investors themselves, like maybe they are running their like pre-seed seed funds, since like ARK invests in more like iconic companies that are like towards they already finished the brand building stage. I wonder, what does this translate into like a earlier stage investors? Should they pay attention to these different sectors that ARK is paying attention to, and then how does that translate into investing strategy? Since at the beginning, maybe like to invest in a Tesla, it's kind of like once in like 100,000 investments.
Right.
How do you suggest people to pay attention to the earlier stage of these like iconic companies?
Well, it's tricky, right? Like I just spoke to I won't name, but a very, very, senior prominent VC who hosted us for an event a few months ago, and he's in the Bay Area. He said every single one of the companies he's been really glad he invested in had to pivot. That is the single most defining factor, which inherently tells you that a lot of this is unpredictable, right? So, in fact, I just had drinks with another very successful close friend and VC here in Europe last night, and he said something kind of similar, right? So I think one, obviously, just factoring in that this is a game where there is a ton of luck as well, and however the quote goes, better to be lucky than good. But one has to engineer that luck by being in a lot of amazing companies, and the best driver of great luck is not really great luck, it's talent who know how to do things like pivot in the light of an emerging, incredibly complex world, right? Where new opportunities are coming and going and dying and what have you. So I think that's, the importance of talent is not going away. I think there's obviously a really important question any early stage VCs have to ask themselves about the sector they want to be in and the technology areas, most importantly because of capital intensity. So like my angel investing portfolio, which I don't have time to do a ton of right now, but I do a little bit of, it's very different. Like I never do biotech pretty much. And, because I'm just scared of the series of capital intense rounds that get piled up on top. So it's really like in those early stages, how is one going to add disproportionate value? How concentrated, how focused do you want to be? A lot of this stuff is obvious, I guess. But again, the reason I mentioned the pivot point is, Tesla itself, not exactly pivoted, but, certainly took a circuitous path, right? Like if you read the Walter Isaacson biography, that much is very clear. And, there were certain events that happened, like the factory in Fremont and other things. And the company would be a completely different company if those things hadn't happened. And some of those were unpredictable, right? And some of them were sort of desperate times, desperate measures as well, and just taking successive, courageous, big bets on something. And so if you're looking at like a biotech or a hardware company or something very capital intense, often you're going to see that kind of thing because the companies about are the ones that are successful because they did that and it went the right way. But of course, there are many companies that are just dead and they've gone and no one's ever heard of because they were the same kind of company and they just went the wrong way or got bad luck. Then of course you've got the much less capital intense kinds of companies that you can, I personally like those for the early stage investing because at least quite early on whether you've got something that looks successful or not. You can test traction. So if you look at our ARK VC earlier portfolio, they're much more in the way of things like fintech. We'll do some Web3 and blockchain and certainly AI companies where, like enterprise AI, where it's pretty much clearer within, 1 to 3 years. Is there some traction here? Has a pivot had to happen? What was the outcome of that pivot? Do we still have conviction in what the founders are doing? So, that's why you'll see certainly in our portfolio, and obviously different seed investors have different areas of expertise. And we work with a lot of really, really great seed investors who, now they know we're doing private investing are really starting to send us deals. I guess I didn't talk that much about stage breakdown, but we try to keep the portfolio at least 50 to 60% quite late stage, as in Series B and beyond, a bunch of unicorns and pre-IPO companies, but definitely keen to do more in the Series A kind of setting, at least could be 20, 25% of the portfolio, and very selectively some seed and pre-seed even. But those are more likely to be in non-capital intense areas where we're quite deeply expert, like in fintech, where we could almost be like a strategic investor, if that makes sense. And then, I guess it's a related point, but, we try to be, given that we're not leading, we try to be as helpful as we can in other ways. So, many companies we see and we love, and we say, actually, we'll help you try and find the lead. So we'll send it to our network of people that lead Series A or whatever. And so, increasingly, I'd actually like to do more of that, where we have a strong conviction. We just say, look, we put our hands up and say, look, we can't lead and we don't lead. It's not what we do, but we'll be as helpful as we can in finding you a lead. Or in others where we've got some conviction, but, they're already kind of a hot company or whatever, and they've got a bunch of lead term sheets in the works, and that's fine. And then, they'll send them to us and then we can take a view. But where we try to be helpful, relatedly, is certainly we have a rich and deep open research ecosystem where we can help tell the story of the company and the founder's narrative and whatever they'd like to get across. And we've got good examples. Like we did Figure AI is maybe quite a nice example of a lot of these things, because we did Figure AI in Q1, the 675 million round that OpenAI was in and NVIDIA. And previous to that, in Q4, I think it was, we did a podcast with Brett Adcock, the CEO, who we've known actually from previous days at Archer, where he'd seen what a loyal and supportive investor ARK is on the public side, and figured that we behave similarly and think similarly on the private side, which is true. And then Kathy and I were able to visit Brett, and he showed us around the factory. Super exciting. We did not get our cup of robot coffee as the YouTube demo shows, but next time hopefully. And but we were also able to make enterprise intros to potential customers and clients, which is the second big area we try to do. So it's like, we're very connected into a lot of large private companies and especially public companies, so we can often make like a C-level introduction to even very small companies. I've got loads of other examples of that. So the open research ecosystem, introductions, and then we try to also help with direct feedback and thoughts, and actually beginning to work with people on talent and thinking through their sales pitch, BD pitch, fundraising pitch, all of those things. So we try to be as helpful as we can, given, as you said, we're a little bit more like public market investors on the private side. So we are taking a portfolio view. We have some level of limited bandwidth, but we really have got to try to go above and beyond for every company we actually do make the work and dig into investing.
Totally. I think you just mentioned about you guys would invest, I would say put 50 to 60% in the Series B and above, unicorn kind of status companies, and then maybe 20 to 25% of Series A. And I wonder, do you guys do follow on round of funding? So keep following on until the company IPO, or I guess do you have a general portfolio construction set of things that you could share with the audience?
Yeah, very much where we keep and build conviction, we absolutely want to keep building into that position. So really, because we're slightly limited at the moment in the check size to that sort of 3 million-ish is typically the upper end of what we do in our typical check. We can do up to 5. I think into next year we may do up to 10 million entry checks, but let's watch the space. But we will absolutely build a position through several rounds, and that's definitely the intention. And so for where we keep conviction, we absolutely would love to follow right through and keep building into the crossover round and actually do the IPO if that's the right thing. We can, whether that's from the crossover fund that we're talking about, or whether we actually do the IPO from the ETFs. At that point, the ETFs can come in, and as you know, they're much bigger, sort of at the moment in the 25 billion-ish AUM range. And we've got lots of examples. So we did an IPO, for instance, we did Tempus AI recently, both in the IPO and then we traded into it publicly. So we publish our trades, as well, so people can see that. But we traded into it, in the weeks following the IPO, and we're excited about that company as an example. So yeah, we very much see it as a continuum, and part of the philosophy is that great companies, great leadership teams, founders, and great products and technologists, doesn't really matter if they're public or private or what have you. Obviously, there are nuances that come with those things and certain pros and cons to each route. But there are many companies on the public markets that in the old days, might have remained private and arguably should have. There are many private companies that in the old days, recent old days, would have been public and are opting to stay private for much longer. Those deeper pools of capital that we're seeing, and for those companies, sometimes it can work really well. We've obviously seen with companies like SpaceX is a really extreme example that is in the portfolio, in the venture portfolio, but also Epic, which is in there, Epic Games, and obviously famously Uber and several others. A lot of the big, large fintech companies staying private for much longer. The company that you mentioned that I co-founded, Freenome, has raised nearly $1.4 billion on the private markets from incredible investors, including folks like Roche, and some of the big late stage funds like T. Rowe and Fidelity and Janus and others. So definitely there is capital there for great companies doing great things, but obviously so many pros and cons to being public. One needs to think very carefully about whether that's the right route for the company and when, and what in the ever-changing landscape of news flow that one wants after being public. And obviously we've seen huge ups and downs in that whole thing since 2019. It's been a real roller coaster ride, right, for a lot of these companies, especially pre-revenue or largely certainly pre-profitable companies. What I was going to say, there's actually a blog I put out built on a SpaceX Spaces that we did with Elon Musk in Q4, which highlights a lot of it. We did 100 minutes with Elon. It's up there on the ARK site, or maybe you can share it after. But where he talked about the trials and tribulations of being public with Tesla, and how he, was very, very thoughtful about whether he would take companies public again, and on what grounds he would take a company public, and just expressed a lot of hesitations for that kind of route. I mean, our dream in the long run, really, for the ARK Venture Fund, I suppose, is that with our mission to democratize venture capital and bring it to this big, non-accredited audience of retail investors for the first time, and really bringing them access, all those folks, to this asset class that they've been locked out of. And we already have, I think, around 16,000 individual investors, which is, an unprecedented bringing of this asset class, high quality venture deal flow to this asset, to that audience. Our dream is that eventually we have many millions of individual investors deploying billions, many billions of AUM and capital, and we can actually be a significant participant in the ecosystem, actually making deals happen that would not happen otherwise, and permitting companies to stay private for longer that would have been forced to go public to access those pockets of capital, like this third way, if you like, that tries to harness some of the best of both worlds, if you like, at least for a time. So that would be, part of the ultimate long-term vision. So with that, I should probably wrap up soon. I have to go to a public company callback.
Totally. So I want to just do like a quick 30-second fire round for you, and then we will just wrap up. Okay. What's your favorite book?
Favorite book ever probably is Catch-22. Right now, I'm going deep into a nerdy field, not really nerdy, it's actually a very interesting field of complexity economics from the SFI Santa Fe Institute. So my favorite book right now I'm reading is Making Sense of Chaos by Doim, I think you say Farmer, from the Santa Fe Institute. So it's a really interesting branch of where economics meets biology, essentially.
Who made the biggest impact in your career?
Probably Riley, my co-founder of Freenome.
Who would you invite to your dinner party?
Oh, that's a tricky one. I have this concept that it's. I mean, I love diversity in a dinner party of every kind, right? Like, and I love an agent provocateur at some level who's going to turn a dinner party into a fun but engaging debate where not everyone agrees with each other. There are loads of examples of people like that. I suppose I spoke to someone that I really liked yesterday, and I have never invited him to dinner party, but I'd love to. Rory Sutherland from Ogilvy, who's the vice chairman of Ogilvy and a great TED speaker. And he's just one of the most fantastically entertaining humans there
are. Where can we find you outside of work?
Outside of work, probably asleep at the moment, sadly. Maybe on a snowboard in Val d'Isère.
Amazing. Well, Charlie, thank you so much for coming on the show today.
Thank you very much, and happy to answer any follow-up thoughts or questions, and just be part of the journey. And we're very excited about. By all means, send us exciting new companies and great talent. We're always here and for thoughts and feedback.
Amazing.
Thank you.
Thank you so much. Let me quickly
Yes.